So my topic today, evaluating the consequences of alternative management strategies for the enterprises in Northern Australia. And I'd like to start by acknowledging my co-author on this work, Fred Chudley, who's Principal Economist also with the Department of Agriculture and Fisheries Queensland. I'd also like to acknowledge the many beef R&D specialists across Northern Australia, primarily from the Queensland and Northern Territory government departments, agriculture departments, who we've worked with in this project and provided input and who have been really critical members of our project team. This work has been funded by the Queensland Government Drought and Climate Adaptation Program, and the work I'm presenting today is just one aspect of a larger project of work. And for those interested, you can access that extra work from the links at the end of my presentation today. So today I'll be following the usual format in my presentation. I'll start with some background of the challenges faced by northern beef producers, which frames our research objective, a brief explanation of the methods we've used in this whole farm economic analysis, a sample of some of the key results, and a discussion of the key insights with regard to both the results themselves and the framework, the economic framework we've used to conduct the analysis. I'll finish with some conclusions, of course, and provide some links to our project outputs and reports at the end of the presentation. So to start with the background, we know that there are major challenges facing our beef businesses in Northern Australia. They face large intra-annual and decadal rainfall variability, which in turn causes great variability in production and also in profitability from year to year. Quite separate to that, often we have, they're experiencing variability in commodity prices, declining terms of trade, and an ongoing disconnect between the asset values, and by that we mean property values largely, and the returns that producers can make from that asset. So therefore, to remain viable and to build resilience, these beef businesses need to regularly produce a profit and build capital. And when they're looking at ways to improve their profitability, they have to determine how they incorporate new technologies, new management strategies into their business, and whether or not those technologies and strategies will add value in terms of improving whole farm profitability. So that leads us to our research objective in this project, which was to demonstrate the value of an appropriate framework to assess alternative management strategies and new technologies for beef businesses in Northern Australia specifically. So the question we were asking was, what are the strategies or new technologies most likely to improve profitability and resilience of beef businesses in Northern Australia? So in this project, we tested a large number of strategies across various regions in the north, and we could categorise these broadly into 4 groups. So strategies which might improve overall herd biological performance or enterprise profitability, so targeting the whole herd, the whole business. Strategies which are targeted to improving breeder reproductive performance, those that specifically target steer growth rates, and also market alternatives. And I've put a few examples on this slide, but we looked at a much larger range of strategies, and these were specific or tailored to each region that we worked in across Northern Australia. And I'll be presenting results for just a selection of these strategies in my presentation today. So this table is just intended to give you an idea of the range of strategies we looked at. This is an example for the Central Queensland region, and it's not intended for you to read these results, but just to give an idea of the breadth of strategies we looked at for each region. And what we were wanting to do within a region was identify which strategies may improve overall business profitability, which strategies may make little difference, and which could potentially send you broke over time. And they are the red lines that go all the way across on these tables. And I should point out that most of these strategies were suggested as positive changes by the teams that we were working with to develop up these strategies, and positive in terms of producing a known production benefit, a known biological benefit. Another way to frame the relevance of this work to beef producers, or the relevance of these results, is that you can look at these results in terms of, if you have limited capital to invest in your business, where should you best invest it if you're looking to improve profitability? So in this work we used whole farm economic modelling And this involved a combination of rigorous science and a whole farm perspective. So we needed a really clear understanding of the whole farm and the likely response to any change due to a management strategy or a technology. So to do that, we needed to work with interdisciplinary teams, and we needed to consider a whole range of various disciplines, so soil science, agronomy, animal science, engineering, agricultural economics, managing, marketing, politics, sociology, and their associated subdisciplines where relevant. So we needed to bring in a large group of people to work with us on this project. Economics was the core and integrating discipline. And I'd like to highlight that this same whole farm approach is relevant to any production system or property anywhere, not just to these northern beef enterprises we were looking at in this project. So this modelling was a property level analysis, a whole farm analysis, and we were conducting partial discounted cash flow budgets, so a marginal analysis. We're estimating the extra return on the extra capital that we've invested to implement a new technology or to make a management change. We used the Breed Cow and Dynama herd budgeting software, which was developed by our Queensland Departmental Ag economists over many years. The most recent version was released and published in 2017. So in this whole farm economic modelling, we developed up representative beef properties for each of the regions in the north that we looked at. So these were example constructed properties. We spent a lot of time developing up assumptions for these properties so that the properties would sit sensibly within each of the regions. And we derived these assumptions from wherever data was available, good research data and industry surveys, and also the expert opinion of these experienced staff, DPI personnel and industry experts as well. And then for each of these representative enterprises, we then evaluated the effects of these alternative management strategies and technologies on the production and the economic performance of the cattle enterprises over a 30-year time period. So in developing up our assumptions, we needed to form long-term expectations that take variability into account, in particular year-to-year climate variability. And so this framed our thinking in terms of forming long-term estimates about the biological performance of our base cattle herds in terms of mortality, reproduction and growth paths, and also cattle prices, of course. So we used historical price data over the last 6.5 to 11 years, depending on the region and the markets that were relevant, and we used those to derive our expected cattle prices that we used over this 30-year analysis. We, to date, our project has looked at 6 regions across Northern Australia, but in this presentation I'll focus on examples from 4 disparate regions to give an example across a range of production environments. So I'll present results for Central Queensland, here in the relatively more productive region of the north, also the Northern Downs region of Queensland, the Northern Gulf up here in the more monsoonal lower productivity environment, and the Katherine region as well. So I'll provide just a brief background to these representative enterprises across each of these 4 regions. Our Central Queensland property is based here in the subtropics, and as I've said, this region is a relatively productive region of the north. The Northern Downs property is in a semi-arid climate here, and our Northern Gulf and Katherine regions are monsoonal climates up in this part of the world. Now, when we're looking from left to right across this table, in terms of the regions, we're moving from a relatively higher productivity to lower productivity, and smaller, more intensive to larger, more extensive properties and beef production systems as we move across that table. Now, phosphorus status is a really important issue across the north, so I just wanted to highlight that these particular representative properties that we derived for CQ and Northern Downs were considered to be adequate for phosphorus. Our Northern Gulf property was considered to have a deficient phosphorus status, but our base herd was adequately supplemented for phosphorus, so that was our starting point in the Gulf, whereas for our Katherine base herd, that was an acutely deficient land type, but the herd wasn't currently receiving adequate phosphorus supplementation. So that's a really important point to mention. So as I've already mentioned, we're moving from a smaller property size to larger property size as we move across this table, and corresponding herd sizes. When we're thinking about the herd, we have a controlled mated herds in central Queensland and the Northern Downs with one main weaning. In the more extensive environments of the Gulf and the Katherine region, we have continuously mated herds in our base properties with two main weaning rounds. Our weaning rate ranged from 78% was a long-term value in central Queensland, down to 54% in Katherine, and herd mortality ranged from around 2 to 4.5% in the Katherine region. In terms of our steer live weight gains, our long-term expectations for each of these regions, just to put things in context for our audience, these are post-weaning annual live weight gains. Those range from 180 in central Queensland down to 90 in the Katherine region. And we're targeting feed-on or feedlot entry steer markets was our main target market for the base herd in central Queensland and the Northern Downs, whereas live export was our key steer target market for the Northern Gulf and Katherine regions. So that's just providing some context of those base enterprises in each of the four regions I'll talk about today. In presenting the results, I'll focus on some key economic metrics up here, which I'd just like to take a moment to explain. And just to remind the audience that we looked at a whole range of strategies for each region, and I'll just present a selection today. The strategies that I've selected to present to you are those that really show a range in the outcomes that we got. So those that produce the most positive returns and those that produce the most negative. And as well, I'll present some of the scenarios where the results have really challenged our thinking and challenged our paradigms and made us reframe our thoughts about what are some of the strategies we should be focusing on in the north. So as I've already stated, we conducted a marginal analysis, so that's considering the extra costs and extra benefits, and the results in this first column indicative of the extra profit per year to the business as a result of implementing these strategies or technologies. So this is a net present value. It's the net returns over the life of the investment, and it's converted to an amortised or average annual value over the 30 years. So these results are the extra profit per year, every year over 30 years of the analysis. We've also have results for peak deficit in cash flow caused by implementing the investment and the payback period, the number of years before the investment pays back. And these two pieces of data are really important in indicating the riskiness of these management strategies or technologies. And the final row of data is the internal rate of return, so the rate of return on the additional capital invested in the business to make that management change. So I'll start with Central Queensland results, a snapshot of those results. And here I'll present just 5 results for 5 scenarios out of a total of 35 that we looked at in this region. And to provide some context, it's useful to bear in mind that our base herd or property here in Central Queensland produced a net profit per annum of around $100,000 per annum. So any profit or any change in our profit is adding or subtracting from that net profit per annum, just to put things in context. So in Central Queensland, the most profitable strategy of all that we looked at was establishing Leukina, which is a tree perennial legume, into perennial grass pastures. And in this particular strategy, we established sufficient Leukina to feed all steers from weaning to feed on or feedlot entry weight. So that added a substantial amount of extra profit per year, so around $46,000 per year on average, each year over 30 years, but a substantial peak deficit and a fairly lengthy payback period, which need to be considered. A strategy of interest in that it produced a fairly negligible change to our annual profit of the property was this strategy of genetic improvement of weaning rate. So this is purchasing bulls with better genetics that can improve the weaning rate of breeders in the herd by 6 percentage basis points. So that made very little difference to our base profit, our base herd net profit. In all of our regions, as for Central Queensland, we had a large or substantial number of strategies that and strategies that have been previously favoured, where we know we can get a production response, a really good biological response, but the cost of achieving that response is greater than the benefits at the whole farm level. So at the whole farm level, we're reducing our profitability despite getting those sometimes really good production responses. And examples for Central Queensland here are supplementing first calf heifers, lactating heifers to improve our reconception rates, and annual forage cropping. So this example is for forage oats and providing that to steers to get them to feed on weight, having a substantial negative impact on our whole farm profitability. The final example I have here for Central Queensland is an example of targeting a specific market, and Wagyu beef is of interest to many producers in CQ and in other areas. In this particular example, we were looking at converting our Bos Indicus crossbred herd to one that produces Wagyu beef, and we looked at a number of sub-scenarios within this, but this particular example is one we looked at where we assumed that 100% price premium began reducing from year 10 of the analysis. So, and we know that this is a 30-year analysis. So we looked at a number of these sub-scenarios where we looked at whether or not the price premium reduced and how long after the start of our analysis or the start of that change over to Wagyu beef it reduced. So if we made this assumption that the price premium began reducing from year 10, this strategy had a substantial negative effect. So it reduced the profitability of our business by around $42,000 per year over 30 years. So we'll move on now to a snapshot of results for the Northern Downs. So the Northern Downs is here in this semi-arid environment in Queensland. It's a phosphorus adequate environment. I'll present here 5 examples out of a total of 39 that we looked at for this region. And just to provide some context, the base herd net profit per annum was $184,000 in this region. So the most profitable strategy in this region was one where we looked at converting our breeding herd across to just a steer turnover or trading enterprise. And this produced a substantial positive result, so $62,000 extra profit per year over 30 years from implementing this strategy. And I should say that this would produce a positive outcome in any of the regions we looked at, but we were particularly interested in looking at this strategy in the Northern Downs region, because in the Northern Downs we have very large seasonal variation in rainfall and frequent droughts, and a conversion to a steer turnover or trading operation is often suggested as a more flexible way to manage the seasonal variability in this environment. It's easier to offload cattle and then bring cattle back on. So that is that's why we're interested in that, and it did produce an improvement in the profitability of the business. But of course, we need to bear in mind that this is a more risky strategy. There's price risk involved in trading large numbers of cattle, and there's also a fairly substantial peak deficit and payback period involved in moving from a breeder herd to a steer turnover enterprise. So that needs to be considered in looking at this strategy. I've included an example of using hormonal growth promotants for steers for this region, and we looked at HGPs in a number of our other regions as well. And this is interesting in that it really highlights the importance of the price margin and price premium for these markets. So we looked at 2 sub-scenarios within this. We looked at the situation where we received the same price for our steers, so we're selling them at the same time but a heavier weight, and in that instance HGP's at around $9,500 per year to the business over 30 years. But should we receive a 10 cents per kilogram price penalty for those steers, so selling them at the same time and weight, or same age and weight as in the previous scenario, then we see a reduction in profitability. So this really highlights the sensitivity to price premium. The final 2 examples I wanted to show for the Northern Downs region are examples of where we modify the base property to look at specific issues for a region. And we did this for for all of our regions where we wanted to look at an issue that perhaps wasn't considered representative enough to be included in our representative property, but was a really important issue for that region we wanted to examine. So in this instance here, we wanted to look at this issue of prickly acacia control. And prickly acacia is, for those who don't know, it's an exotic woody weed. It's very invasive and it's a big issue in that Northern Downs area. So our representative-based property that we compared all of our other strategies to had minimal prickly acacia infestation, but we wanted to look at a property that had a fairly substantial prickly acacia issue, and in this instance about 80% of the property having some level of prickly acacia infestation. We wanted to look at property level control in the first instance and then maintenance of that over 30 years. And if that were done, the analysis indicated we could add substantially to our base herd net profit, so around $129,000 per year every year over 30 years, but really large peak deficits to achieve that and long payback periods, indicating that that's unlikely to be a feasible option, or it's beyond the capacity of most property managers to do that, and they'd need to look at a staged approach to control, which is what we did in some sub-scenario analysis as well to tackle or to investigate this issue. The second example here of where we modified the base property to look at an issue or demonstrate an issue was this issue of selecting the optimal age of turn-off of our steers, so the optimal sale age. Now in all of our base properties, we selected the optimal age of turn-off as our base, and we can identify that very readily in our economic herd models, and in this instance for the Northern Downs that optimal sale age was 31 months. But we know that right across Northern Australia as well as in the Northern Downs there are lots of beef producers who target a weaner turn-off age. And we know that that's the least profitable age of turn-off that producers can select, but that producers often get caught in what we call the weaner trap, where they're trapped in that weaner production. And you can see here that if we look at moving our business from a weaner turn-off target to the optimal of 31 months, we can add around $71,000 per annum over 30 years to our whole property profit. So that's quite substantial. However, there's quite a substantial peak deficit and payback period of 2 years here, which can be difficult for some property managers or some businesses to overcome, and that's what keeps people in this weaner trap. So moving on now to our Northern Gulf property up here in the lower, a relatively low productivity area of Queensland. In this region we actually had a negative base herd net profit per annum of negative $23,500 per annum, and so of course we were really interested for this region to find some strategies that could improve that profitability and ideally make the business a profitable business. I'll present 6 out of a total of 25 strategies that we looked at for this region, scenarios. And in terms of the most profitable interventions for this region, the standouts were establishing the perennial legume stylo into pastures and homebred bulls. So in the stylo scenario, in this example, we looked at establishing just 500 hectares in this instance for steers, and doing that added around $17,000 profit per year over 30 years. But with a peak deficit here that's fairly substantial and a payback period of 9 years. Also, we had a profitable outcome from this scenario of homebred bulls, and by this we mean that the managers or the business invests some substantial time in objective selection of their own bulls from the herd, and in doing that objectively so that the performance of the herd has not changed over time. And so instead of buying in bulls. So this strategy added around $16,000 profit per year to the business, had a much smaller peak deficit than the stylo scenario and a much reduced payback period. We've also looked at genetic improvement of weaning rate, and we did that in all regions. But in this particular region, that added around $6,800 to the bottom line. And as mentioned previously, this involved buying bulls with better genetics that could improve the weaning rate of breeders by around, or by 6 percentage basis points. And again, in this region, as for others, we had a number of strategies that we know will produce a positive production response, but reduce the overall profitability of the business. And so some examples that I've presented here include supplementing first calf heifers, lactating heifers to improve their reconception rate, providing a molasses production mix for the steer tail. So in the Northern Gulf, as in the Katherine region, where we have continuously mated herds and 2 weaning rounds, we have a cohort of steers which is lower live weight and not able to meet market targets. And so this is what we call the steer tail that we're targeting with these production supplements. And we also looked at a strategy here of growing sufficient forage sorghum silage to feed all steers, which also had a fairly substantial negative impact on the business. So the final region I'll look at in my presentation today is the Katherine region of the Northern Territory. So again, a fairly low productivity region, a much more extensive and region and very large property sizes, and a base herd net profit per annum for this property of $673,000 per annum. We'll present 5 out of 43 total scenarios that we looked at for this region. And the most profitable of all for this region was phosphorus supplementation of the entire herd in this region. So just to remind the audience, this is an acutely phosphorus deficient base property, and it was unsupplemented. Our base herd was unsupplemented, and we implemented effective or sufficient phosphorus supplementation for the entire herd. So this added substantial extra profit per year, so around $332,000 per year over 30 years to the base property. Very high internal rates of return because we're getting that benefit every year, and we're getting that benefit fairly immediately. Fairly short payback period, but still fairly substantial peak deficits to get there. The next most profitable strategy in this region was again establishing these stylo pastures for steers, and stylo being a perennial shrubby legume, for those not familiar. In this instance, we looked at establishing sufficient stylo for all the steers, and that added substantially to the profitability of the business. Again, we looked at homebred bulls in this region, so objectively selecting bulls from within your own herd rather than purchasing bulls. And this also added fairly substantially to the profitability of the business, and with a much lower peak deficit and much reduced payback period compared to, say, stylos for steers. Again, in this region, we had examples where our strategies that can produce a production response just don't result in a profitable outcome for our business. So the example here was concentrate feeding the steer tail, again, and supplementing our first calf heifers to improve their reconception rates, having a fairly substantial negative effect on whole farm profitability. So I'll move on now to summarising some of our key insights from this work, and this will cover 2 aspects. Firstly, key insights about the strategies themselves, and then also our insights or learnings about using this whole farm economics framework that we have used in this study. So starting with our key insights about the strategies themselves. Importantly, in each region, we were able to identify strategies that could substantially improve the profitability of that base property. So that was really important and encouraging. However, we identified many strategies that had a negligible effect on annual enterprise profit, and by that we're talking really plus or minus $5,000 per annum, so which really is within the bounds of error in the analysis. And we also identified many strategies, as I've highlighted, that had a negative effect on whole farm profit, and that was despite a positive production response that we know we can achieve. So addressing a peat deficiency and introducing our perennial legumes, they were consistently profitable strategies across Northern Australia, and we've looked at other regions other than those four I've identified, but they were consistently profitable strategy where relevant. So where we had a peat deficiency and where perennial legumes were available that were adapted and suited, these were two clear winners in terms of improving profitability for beef producers. However, that we also had strategies that were quite consistent in reducing profitability for beef businesses across Northern Australia, and these were production feeding, so molasses, silage, grain, or annual forage crops as well, so forage, oats, sorghum, and lab. When we looked at strategies to improve the reproductive performance of breeders, and the examples I've presented here are genetic improvement of weaning rate and supplementing first calf heifers, we also looked at strategies to reduce fetal calf loss and some others. We found small positive to large negative effects on enterprise profitability from making these sorts of interventions. And so this really emphasised to us and to our teams the critical importance of implementing low-cost strategies to improve profitability. So paying attention to breeder body condition score and optimising herd structure. So identifying that optimal steer sale age and optimal cow cull age. And I should also mention that addressing these issues helps to minimise drought risk as well, and that's a really important issue that we've looked at in other parts of our project. Now, the results indicated that the low-risk production systems were really low-return production systems, and that for producers to improve their profitability and get better returns, they really need a capacity to manage risk. Because most strategies that were likely to improve profit are also likely to increase the complexity and the riskiness of our beef production systems. A good example of that is property-level control of the exotic woody weed prickly acacia. To do that, or doing that, could result in a 13% internal rate of return, but require more than $1.3 million to be invested over the first 4 years of treatment. And compared to a base property net profit for that prickly acacia infested property of $169,000 per annum, that sort of investment is going to be beyond the capacity of that business. So in identifying some of these issues, we're then able to look at sub-scenarios of how some of these profitable strategies might be implemented, and often it's a staged approach. And so we've looked at various sub-scenarios within these analyses to address some of these issues. So improving returns requires intensification. That was a key finding of our work. And we know that increases demands on manager skills and increases income volatility and risk often, but certainly increases demand on manager skills. So it's really important that's considered when we're looking at some of these strategies. So good examples of that, of some of these profitable strategies that require intensification, are Lakina, stylos, moving from a breeding operation to a steer turnover or trading operation, and also breeding your own bulls. All of these require increased demands on our manager skills. Another interesting point from our work and our results was that inflexible production systems, so strategies that reduce the flexibility of a business, were generally more risky and less resilient. And examples of that were strategies that affected market access or really targeted into alternative markets, so like the organic beef or Wagyu markets, or using HGPs. So that was an interesting point as well. But really the key point for us when we're thinking about all of this work was that it's obvious that there are numerous alternative management strategies and new technologies that are arriving at an increasing rate for our beef producers. And the challenge for them and for us as R&D specialists is to identify the ones that make the beef production system more efficient, so more profitable and resilient. And it became really evident to our teams as we're working through these that analysing or focusing in on one strategy in isolation doesn't identify the relative benefits to other strategies, other possible strategies for that region, and that's important. So we really need to look at all relevant strategies for a region and compare them, and also compare back to the performance of the current system to see whether we're really making a benefit for that beef business by focusing in on one of our favoured strategies. I'll conclude by making a few comments about our key insights into using this whole farm economics approach, this decision-making framework that we've used in this project. A key learning for us was that the implementation or development phase of implementing strategies and technologies is critical, not only to the answer that we get, the result we get from our analysis, but also to risk assessment and likely adoption by producers. So it's really important that's considered. But it's often overlooked in analyses, and in particular the benchmarking type analyses that have a historical steady state before and after approach, and they ignore the development process, the time value of money and risk, and so not only can they produce a different result or answer or ranking in terms of strategies, they can also produce misleading information and of limited value in terms of decision making. We concluded that the representative farms approach that we used in this work can be a powerful and highly useful tool for analytical purposes, but they must be properly constructed and targeted, and we found that it's really important to put in sufficient time and engage the right people to make sure those representative farms properly represent and reflect the region and the target audience. And in doing this work, an important point or learning for us was that farm management economics is complex, and the language and terms that are used are new to people and sometimes difficult to understand, and so we needed to take time to properly explain the process, the methods and the results to industry and to the teams that we're working with. So that was really important. We did find that the concepts and the language of this whole farm economics approach is much clearer to beef producers and managers than it is to scientists and extension teams, because they're thinking in that whole farm context. Key point in when we're thinking about technology adoption, it's really obvious to us that these beef production systems, they are human systems, they're really complex, dynamic, diverse systems, and they operate in a really volatile environment. So to achieve adoption of strategies that we believe are more favourable and will have a really positive result for producers, we really need to consider as well the goals, capacities and the resources of managers in our technology adoption and extension of our research. Importantly as well, we've found that conducting individualised economic analyses for specific businesses is a very powerful extension tool and gives the most useful results in terms of technology adoption. And we're fortunate in the department to have a number of agricultural economists who are able to conduct one-on-one work with producers, and we've done lots of that as part of this project and as part of separate projects, and we've found this a really powerful way for producers to put in their own figures, their own assumptions. It's targeted specifically to them, and to see that result for their own business is a very powerful tool in terms of giving someone the confidence to make a change within their business. In terms of guiding research focus, we have found that this whole farm thinking has been really valuable for us in terms of building an understanding of the interactions and interdependencies, responses at the whole farm level, and that we see that as being able to produce the most useful outcomes in terms of identifying where we should focus our efforts in terms of research and extension. So some final concluding points on this slide, and these are thinking about the outputs, or in terms of the outputs from this project, where we've used this whole farm economics framework across the north, working with producers as part of groups and individually, and also with the R&D teams that have been a part of this project. We've found that the results from this work have enabled decision makers, so the beef producers and research and extension staff, to be well informed and to make sound judgments about the technological change and likely results of that change. But critical to this process, we believe, is this role of team learning and building a shared understanding of these complex and dynamic beef production systems. So that process, we believe, has been critical to the success and the outcomes of our project. So I'll just finish by letting the audience know that all of our reports with the whole range of strategies and detail about all the assumptions that we've used are available from our project page on Future Beef. We've got 3 regional reports available from this project phase page so far, so CQ, Central West and the Northern Gulf. We've got 3 more reports underway. Our Northern Downs report will soon be available from the web page. We've also got 13 recorded presentations that you can access from this web page as well, where we explain some of these results and discuss them, and also explain how to use the spreadsheet tools that we've made available from this page as well, that have got examples in them. Our 3 scientific publications that you can access from this page as well, and our Katherine results are also available from the DAF website, but from a different location.